You lost 23% the first year and 62% so far year to date. And you have $19,341.26. And your average return is 24.37%. Now, if you just go online and you look at that, and you see her average return, you think, wow, Bob's your uncle. Santa Claus is here. I want a 24% return every year. Isn't that marvelous? But that's not the case. And I'm going to show you mathematically why this is important to you. And I'm going to show you why greater risk does not equal greater return. And I'm going to show you why less is more. Hello, and welcome to The Laughing Retirement, and another in our video series talking about investments. And I wanted to take a look at risk in this year and return in this year and averages. Now, risk adjusts with volatility, and we call that beta. And one of the most famous, and right now, obviously in the headlines constantly, are the ARK funds, who are led by a lady named Cathy who's gotten some incredible returns and some incredible averages. But I want to show you that the averages don't mean anything. What's important to you is consistency and return. And that's what we're going to talk about today. So I'm going to share screen here, and we're going to take a look at something that I've created. This is a screen of the ARK Innovation Fund. ARKK is the symbol. And these are the returns since 2015. And if you had invested in 2015, 8 years later, you'd have about $19,341.06. Your average return would have been 24.37%. Now, that may seem great, that may seem wonderful, but the average doesn't mean anything to you. And I'm going to show you why. And I'm going to show you why it is important to take less risk as opposed to more risk, because the other thing that is important is that just because you are taking more risk does not mean that you're going to get a greater return. It was taught to me when I started in this industry over 40 years ago. It's one of the first things I learned: consistency and safety. And I want you to consider the ARK Innovation ETF. Let's look at it. Now, there's only 3 months in 2015 here, but I took everything as a year all the way through, because it's the outcome and what it shows you that's important, not the fact that they're 3 months because of when the fund started, or they're 6 months, or they're 8 months, or we've only got 11 months in this year so far. In 2015, if you had to put in $10,000 in the ARK Innovation Fund, you've gotten a return of 3.75. The next year, you'd have gotten a return of minus 1.56. The following year, 87%. And you'd have thought, hey, this is tremendous. I put in 10,000 and my money's almost doubled 3 years later. What a great job she's doing. The next year, you got 3.5%, and you didn't beat inflation, but you didn't lose anything either. You have $19,743 when you put in 10,000. This is great. The next year, you got 35%. Now your money's more than doubled. The next year, you got 152%, and now your money is up almost 7 times. And you're thinking, man, this is a great deal. And then 2021 and 22 came along. You lost 23% the first year and 62% so far year to date. And you have $19,341.26. And your average return is 24.37%. Now, if you just go online and you look at that, and you see her average return, you think, wow, Bob's your uncle. Santa Claus is here. I want a 24% return every year. Isn't that marvelous? But that's not the case. And I'm going to show you mathematically why this is important to you. And I'm going to show you why greater risk does not equal greater return. And I'm going to show you why less is more. Let's take a look at this. Right here, average return is 24.37%, and that's done by adding all these numbers together and dividing by 8 years. Very simple. It's the same thing here. I've added all these numbers together and I've divided by 8 years. These are the returns of the S&P 500. Now, this return averaged 24%. The S&P averaged 9.47%, and you're taking 145% of market risk. You're taking a almost 1.5 times market risk to get an average of 24% return. But in dollars, you only have $19,341. What is that really? Well, if I had have taken 30% less risk and I had to put that in the S&P 500, I'd have had roughly $400 less, having taken 30% less risk over the same 8 years. With the ARK fund, I'd have $19,341, and with the S&P 500, I'd have $18,921.84. Wow. A difference of somewhere in the neighborhood of $425. And I took 30% more risk over here in order to do that. So for $400, $425, I took 1.5 times, almost 1.45 times market risk. The average here is 9.47%. The average here is 24.37%. The averages don't mean anything. And taking a higher risk does not say you're going to get a higher return. Let's take this a step further. Your expense here is 0.75%. So you're spending 0.75% every year based on what you have in there. Give or take, if you do the math real quick, that's 1,600 odd bucks that you spent in order to get a return that you almost could have gotten. If I put that 1,600 back into the S&P 500 index, you're ahead. The expense in the S&P 500 is 0. The beta is 1, about 0.45 less risk. And the size is huge. The size of the ARK funds is $6.8 billion, and the size of the S&P 500 is $33.5 trillion. Size does not matter. As a matter of fact, if you read Warren Buffett, he will tell you that the more size you have, the worse off you are, because it limits what you can buy. And that's true. Now let's take a look at lowering the beta again. Let's take a look at an 8.6% return, consistent 8.6% return. Less risk equals more consistency. Less risk does not equal necessarily a less return. Less risk does equal more consistency. More risk does not equal more return. I've proved it right here. The expense of this fund, if you want to call it that, this is your money, and you're just trying to get an 8.6% return, which incidentally is not difficult. You got a beta of 0.73. Now, how did I get that number? Well, I took the 8.6% that I want, and I divided it by the 11.82% historic return, according to Investopedia, of the S&P 500, and I got 0.73. Because the beta of the S&P 500 is 1. So if I divide the historic return by the return I want, I get a beta. 8.6% return every year, consistently, is $19,348. The ARK funds, taking almost 1.5 times market risk, got you $19,341 less money. You see, this is inconsistent. This will be more consistent because you're taking less risk. If I buy a bond, if I buy a government bond with no risk at all, I can say I'm going to get a 5% return or whatever that bond is giving me, and that's automatic every year. I can count on it. I know what I'm going to get at the end of it. That's consistency. If I buy a stock with a beta of 0.24, which you can do, with a very low beta, it's going to be more consistent because it is less volatile. If that stock pays me 5%, I can count on that 5% much more than I can ARK Fund's Cathy Wood's average of 24.37%. So let's wrap this up. The point here is simple. The less risk you take, the more consistent your returns are going to be. Higher risk does not equal higher returns. The market goes up and the market goes down, and certainly the great manager, Cathy Woods, could not get out of the way because that's where her fund is. You see, just because you're taking greater risks is not going to mean you're going to put more money in your pocket. Less is truly more. Warren Buffett didn't buy the hot stock. He bought the lowest price, best, most consistent deal he could find. If you like this video, comment below, push the like button, subscribe to our video series because we have a lot more coming. Go to our Facebook group, The Laughing Retirement. Join us, where we'll talk about retirement, we'll talk about investments, we'll talk about a lot of things. Send me a comment. I'll comment back. I'm Chip Stites, your host and creator. Thank you.